The opinions expressed by Karen Scott Mims and the guests on this podcast are their own and do not reflect the opinions of this podcast platform. All statements and opinions expressed are based upon information that's considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risks and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendation appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor whom you have specifically retained to determine if it's suitable for your specific situation. This podcast is designed to provide accurate and authoritative information with regard to the subjects covered. Investment advisory services are offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Harbor Point Wealth Management are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Income regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Income regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance products and guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone Capital Management. Most people simply ignore taxation through the 4 phases of your wealth. Instead of understanding the 3 tax buckets, you arrive at retirement with a huge 401k in the tax-deferred bucket and ignore the taxable and, most importantly, the tax-free bucket. How can the middle-class millionaire, average Joe and Jane, be so unprepared about how to protect their wealth using tax loopholes like the wealthy 1%ers do? Easy. Welcome to the Tax Smart, Tax Zero podcast. This is a show about tax-free wealth. Financial advisors sell rate of return. Annuity salesmen sell what else? Annuities. And part-time tax preparers sell a 1040 to submit on April 15th. But the real goal is to implement strategic tax planning. We invite you to take the journey and explore the path to the 0% tax bracket. It's time to divorce Uncle Sam from your wealth. And now, your host, noted tax attorney and private wealth strategist, Karen Scott Mims, Esquire.
Hello, everyone, and welcome to the Tax Efficient Retirement Planning Show, yet another episode of Tax Smart, Tax Zero. I am your host, Karen Scott Mims. Thank you so much for joining us today. Well, we have an absolutely fabulous show for you today. Our show is entitled Money and Marriage versus Wealth and Wisdom. When married, filing separately makes perfect sense. Oh my. So I'm going to start by saying this is a show about tax efficient retirement planning. You know, the concept that you finally begin to think about around, we'll say age 55, and realize that the wealth you thought you had really isn't, because of what I like to call the wealth killer. What in the world is the wealth killer? Well, I'll say to you, the biggest threat to your wealth is taxes. The number one thing that stands between you and true control and financial freedom is twofold. Number one, it's the methodology that you use to save for retirement, i.e. putting money in the tax-deferred bucket, better known as the partnership bucket with Uncle Sam. And number two, the failure to realize that there are really 2 tax systems in this country, one for the informed and one for the uninformed. I would say that both of those things are exacerbated by the failure to master and manipulate the 4 tax buckets. And when I say 4 tax buckets, 3 of them just refer to income tax. So taxable, tax deferred, and tax free. But then there's the last bucket, the bonus bucket. That's the bucket that's both income tax free and estate tax free. So let's say goodbye to the retirement plan, the government plan, we'll say, for your retirement and for your wealth. And let's say hello to tax-free wealth, a lower tax liability, and the path to the 0% tax bracket. Because after all, isn't zero really my hero? It is for me. The wealth that you desire is really waiting for you in the 0% tax bracket, where there's a 0% income tax, 0% capital gains tax, 0% estate tax, 0% excise tax, and certainly 0% inheritance tax. So with that being said, let's get the show started. Well, in order to understand our journey today of education and information, I'm going to tell you about a telephone call that I received about 2 months ago from Sam and Susie. They wanted to come in and schedule a meeting, and they said to me that the topic was going to be couples tax planning. I immediately thought about the estate planning sessions that we had conducted about 6 months prior for Sam and Suzie and their concerns. And one of their concerns was for one of their 3 beneficiaries, right? One daughter named Sarah. She was at the time separated, and since we weren't sure whether or not she was going to either A, reunite, or B, divorce, right? We were very intentionally and specifically saying that we had to have that trust-based estate plan to shield Sarah from being part of, right, or having her funds that she was going to inherit be part of marital property and having a half of it, right, or more go to Roger, the dreaded husband, current, but hopefully ex-husband if Suzie had her way. Okay, so we scheduled a meeting for Friday at 9 a.m. It was very exciting to have Sam and Suzie conduct their first Zoom meeting, right? No traffic, sit in the comfort of their dining room, and I think we may start a new service, right? Tele-tax attorney. But anyway, okay, so let me give you a bit of background about Sam and Suzie. Both retired in January of 2019, and although in our meeting, they both listed their number one priority as tax-free wealth and financial freedom, the activities that they listed were very different, right? So Suzie listed that she wanted to travel, she wanted to take 5 trips a year, she wanted to have a beach house in Nags Head, North Carolina. That was very different. Sam listed that he wanted to fulfill his dream of opening his own landscaping business. And so Sam was completely void of the 3 A's. I call them the triple A's, having an accountant, an attorney, and some form of asset protection for this new business venture that he wanted to start. So Suzie, she wanted to be very supportive, but in all honesty, she had some concerns, right? So I will stop here only to say that I think we can all agree that marriage is complex. I think that's probably an understatement, right? Sam and Suzie, by the way, had met when they were 18 years old. They had married when they were 20. And here we were 42 years later. They were very much still in love, right? Still crazy about each other. And I have to say, whether you have been married for 42 days or 42 years, I think for most people, I could ask this next series of questions and their answers would be similar, right? So question number 1, if you saw your spouse being subjected to unexpected astronomical expenses through no fault of their own, would you help them, right? For better or for worse? Yeah, of course you would, right? Question number 2, same question. What if you saw your spouse being subjected to unfair and astronomical expenses, right? Due to no fault of their own, would you step in and help, right? And then question number 3, this is a bit of a curveball. What if you saw your spouse, right, because of their intentional and purposeful, right, engagement of conduct that was really unnecessarily subjecting them to astronomical expenses, i.e. taxes, would you intervene? So that's my question that I pose to you. In case you have just joined us, you are listening to yet another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. I am your host, Karen Scott Mims, tax attorney, registered investment advisor representative, estate planner, accountant, and certainly my favorite role, private wealth and tax strategist. Let me say this. By Sam's account, his new business venture had a terrific year. He had $50,000 in revenue. He had $80,000 in expenses. So that's a loss of $30,000. FYI, Sam hates it when I talk tax technical, but that's what it was, right? And so Sam, by the way, is having the time of his life. He says that from a business standpoint, he could not be happier. In reality, Sam has neither the skill, the will, the time, or the expertise to properly structure and operate a business, much less provide tax-free wealth and asset protection for he and Suzie, right? So in fact, he questions the purpose of this meeting since he wholeheartedly embraces my role as private wealth and tax strategist, but Sam and I seem to differ in the definition of what qualifies as unnecessary taxation, right? So here's a question. In the 5 years since they've become clients, right, we've taken $1 million of their tax-deferred funds. We've turned it into 1.5 of tax-free money, right? We've structured their assets so that they're in the 0% tax bracket. We've shielded their assets for asset protection purposes. And so I would say to Sam, doesn't Unnecessary taxation, though, also mean unwarranted and unprotected exposure of assets due to errors on the 1040. And so he looks at me and he says, yeah, I think I would agree with you. So with that being said, and as we prepare for break, let me share 3 facts with you. Fact number 1, there are 3 different filing statuses for married people, right? So there's married filing jointly, married filing separately, and then the qualifying widower. Fact number 2, returns, I agree, in most instances are due on April 1st, but that's if you have a liability. If you actually are trying to claim a refund, and i.e. the 1040 is the piece of paper that you use in order to claim the refund, you actually have 3 years to request your refund, a fact that Sam did not know. And fact number 3, here's the biggest fact. There are 3 signatures that go on the tax return. There is your signature, that of your spouse, and the tax preparer. And yours, I would dare say, is the most important, right? And so in these last few minutes, let me say to you, here's what your signature means. Number 1, it means that you have read, understood, and agreed with the content that is contained on the return. Number 2, you have read, understood, and agreed with the tax laws and the theories that are contained on the return. And number 3, you have read, understood, and agreed to be legally bound and obligated with this concept of joint and several liability. Oh my, what a surprise. Sam put his cell phone down and exclaimed, absolutely, Karen, I totally agree with that. Susie, who had never taken her attention or her eyes away from me for the entire 30 minutes, she said, what did you say about that last part about joint and several liability? Well, as we prepare for break, I will say to you, at the beginning, we talked about this concept of tax-efficient retirement planning. You can't control the economy. You can't control other people's foolish behaviors and not wanting to wear a mask, and you cannot control the stock market. The one thing that you can control is taxation. And I said there were 2 tax systems. There is one system for the informed, and there's another system for the uninformed. And so today, we're talking about the concept of unnecessary taxation. Well, I'll say to you, unnecessary taxation is a foreign concept to Warren Buffett. Unnecessary taxation is a foreign concept to Mark Zuckerberg. And unnecessary taxation, most assuredly, is a foreign concept to Jeff Bezos, right? However, it's a reality for most middle-class Americans. And so Susie is becoming quite educated. And certainly our goal is always to provide education and information because until you control your taxes, you are never going to be in control of your retirement. So we're talking today about unnecessary taxation. You didn't understand tax law about running a business. That might lead to unnecessary taxation. Susie apparently didn't understand the effect of what her signature means and what the concept of joint and several liability means. And so understanding tax consequences of your actions and agreements, that is what today's show is all about. In case you have just joined us, you are listening to the Tax Efficient Retirement Planning Show, yet another episode of Tax Smart Tax Zero. I am your host, Karen Scott Mims, affectionately known as your Tax ESQ. Our show for today is entitled Money and Marriage versus Wealth and Wisdom. It will not surprise you to know that in the second half of the show, we are going to talk about the concept a little bit further about unnecessary taxation. But the theme, once again, of today's show, money and marriage versus wealth and wisdom. When married, filing separately makes perfect sense. And in the second half of the show, we're also going to talk about another reason that we supported and suggested to Susie that she consider this married filing separately, right? And so we ask that you stay tuned. Don't go anywhere. We're going to come right back. But let me say this. Did you understand? I just want to do a brief recap. So Sam and Susie have both retired. They're age 62. Susie has decided she's going to spend retirement traveling with the grandkids and all these other things that she has decided that make her happy, right? They give her financial freedom. Sam, on the other hand, has decided to start a business It's a business that makes him very happy, but it's a business in which, I said, he has decided he's not going to bother with AAA, the accountant, the attorney, and a level of asset protection. So Sam, in the first year of the business, right, now that we're at that stage of filing the tax return, the 1040, it has been discovered that Sam had, right, $50,000 of revenue. He had $80,000 of expenses, and Sam said, not a problem because I had a wonderful time and I enjoyed my clients. What Sam, though, is saying to Suzie is that he could go on like this forever. Is that going to be a problem? Yes, it is. And we're going to talk about that. Is Suzie going to be responsible for that problem? Yep. Well, that's the whole idea of married filing jointly. In case you've just joined us, you are listening to yet another episode of Tax Smart Tax Zero. Don't go anywhere. We'll be right back.
Of all the questions you get asked every day, this is one you shouldn't ignore. How much money in your 401k or IRA is actually yours? Not what its current value is, but how much of it will end up in your pockets, not the government's. Remember, you still might owe taxes on that money. And how about tax efficiency? Are you overpaying, or are you keeping every dollar you're entitled to? Look, I know it's confusing, it's complicated, and it definitely isn't fun. That's why Harbor Point Wealth Management works to help make sure you aren't paying more in taxes than your fair share. They have a complimentary report to help make sense of taxes and how they can impact your retirement. Get it today. It's your money. You deserve to know what's at stake. Don't do the IRS any favors. Get your complimentary tax report from Karen Scott Mims and Harbor Point Wealth Management today. Just text the word tax to 301-900-5758. That's the word tax. Text it to 301-900-5758. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Harbor Point Wealth Management are independent of each other.
Welcome back to the Tax Smart Tax Zero podcast. And now, your host, noted tax attorney and private wealth strategist, Karen Scott Mims, Esquire.
Hello, everyone. Welcome back to the second half of the Tax Efficient Retirement Planning Show, another episode of Tax Smart Tax Zero. I am your host, Karen Scott Mims, tax attorney, registered investment advisor representative, accountant, estate planner, and certainly my favorite role, private wealth and tax strategist. So, our show for today is entitled Money and Marriage versus Wealth and Wisdom, when married filing separately makes perfect sense. Well, if you are a regular listener, you know that in the second half of the show, I like to call it Tax Liabilities and Loopholes. I like to talk specifically about how to legally, ethically, and morally disinherit Uncle Sam as the primary beneficiary of your 401k, 403b, 457, or TSP, quite frankly, right? And so I'll start by saying tax law is not only complex, it is ever evolving and changing. So keeping up to date with new tax legislation, tax court decisions, IRS notices and memorandums is one of our most important functions. The other is using the tax code, analyzing and using it, quite frankly, for the creation, preservation, and protection of your tax-free wealth. Because around here, we believe that zero is my hero, and when we talk about the path to the 0% tax bracket, we're talking about a 0% income tax, a 0% capital gains, a 0% estate tax, a 0% excise tax, and a 0% inheritance tax. So, in the first half of the show, I introduced you to Sam and Suzie, and Sam and Suzie, we talked about them. They are both age 62. They have been married for 42 years. Goodness gracious, that's a very long time. They are both retired. And one of the things that they were talking about was the whole idea of paying too much in taxes and, more importantly, unnecessary taxation, right? Two things we absolutely positively seek to avoid. And we do, right, both of those things through this concept called tax planning. It's what we do 365 days out of the year. I would dare say, not to confuse it with tax preparation, that, that assembly line process that you go through once a year. where you spend about 10 minutes drop off, 10 minutes pick up, right? And you really don't understand what's going on. Well, good for you. We are here, and we are here to educate and inform you so that you can make better decisions, right? Okay, so with Sam and Suzie, let me, before we, jump into the details, let me tell you a little bit about their family balance sheet, right? One of the things that we did was that we constructed for Sam and Suzie a net worth statement. It's a very simple formula, right? And so assets minus liabilities equals net worth. And so on their balance sheet, let me share this with you. They had a primary residence, which they own T by E, right? Primary residence, fair market value of $600,000, debt service of $500,000. Kind of odd, I know, but Sam and Suzie actually bought a brand new and more expensive house right at retirement last year with a 30-year mortgage, okay? Asset number 2 on the balance sheet. Suzie has a 401k with a balance of $1.2 million. Suzie has a $250,000 taxable account. Suzie has a $75,000 Roth IRA account. She has a house, her childhood home, that she inherited from her parents. That has a fair market value of $900,000. It has 0 debt service against it. And Sam's asset on the balance sheet is the TSP with $50,000. And needless to say, both the TSP for $50,000 and Suzie's 401k for $1.2 million, they have, right, that kind of 60-40 split. 60% belongs to them, 40% belongs to Uncle Sam, okay? But I have to say to you, Suzie was like, let's get back to that idea of explaining this concept of joint and several liability. So in our last few minutes that we have left, let me try to do that. Example number 1. What if Sam and Suzie complete the 1040, they use the MFJ, married filing jointly status, right? And there's a tax liability due of $25,000 as a result of Sam's business. My question to you is, who is legally responsible for that? Well, both of them are, right? They did a married filing jointly return, okay? Example number 2, same scenario, except the $25,000 is as a result of sale proceeds, right, from Suzie selling some farmland that she owned, right? What's the answer to the question, who is legally responsible? They both are, right? But example number 3, same scenario, right? There's some kind of $25,000 liability, but the question that I asked this time is that from whom can the Internal Revenue Service collect? And you might say, well, in example number 1, it was Sam's business, so they get to collect against Sam. And example number 2, you might say it was Suzie that caused it, so they get to collect against Suzie. Well, no, the answer is when you file the married filing jointly form, right, return status, then they get to collect from either party, okay? And so that was what was causing Suzie to have a little bit of, right, kind of a little bit of uneasiness in her stomach, okay? In case you have just joined us, you, of course, are listening to another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. I am your host, Karen Scott Mims, tax attorney, registered investment advisor representative, estate planner, accountant, and certainly my favorite role, private wealth and tax strategist. So, in our last few minutes that we have left, I want to talk about this concept of tax and wealth optimization, right? Hey, you can't manage, or for that matter, you can't protect what you don't understand. So around here, we have a very basic philosophy. As fiduciaries, we have subject matter expertise. Our goal is to educate you, to engage in planning, to give you advice and strategy so that we have a desired outcome, right? A tax-free, stress-free, but certainly not scot-free retirement. And so while we totally appreciate and understand how much fun Sam is having and how happy he seems, I have to say the tax code is clear. If you want business level treatment by the tax code, you've got to operate the business accordingly. Sam is oblivious to losses and could be in danger of what we call hobby loss status, right? So hobby loss rule of thumb. If you report a net profit in at least 3 out of 5 years, the IRS presumes that it's a for-profit business. If a business reports a net loss in more than 2 out of 5 years, it's presumed that it's a not-for-profit business, right? What does that mean? Okay, well, hopefully you're keeping up with the tax code, and hopefully you're keeping up with the tax code rather than keeping up with the Kardashians, because if you are, you know that one of the provisions in the Tax Cuts and Jobs Act says that hobby expenses were deductible formally as miscellaneous itemized deductions. Up until 2017, the Tax Cuts and Jobs Act has eliminated all miscellaneous deductions for tax years 2018 through 2025. And so, goodness gracious, here we are trying to minimize our tax liability and maximize our tax efficiency. And so in our last few minutes that we have left, let's talk tax strategy. I always say that we need to plan for the outcome you desire, right? So start with the end in mind. Fact number 1. Susie disagreed with Sam's method of operating his business and refusing to engage the AAA, an accountant, an attorney, and some form of asset protection. Not some form, the maximum form of asset protection. Fact number 2, while she supports his happiness, she doesn't seek to have her assets, especially the inherited family childhood home, support Sam's tax liability. Can I tell you the biggest reason that one of our strategies involved a temporary period of the married filing separately status in addition to what we had already outlined above? It's easier to show you through a video. So I made a video, I made a webinar about it, and I let the math do the talking. If that's something that you want to see, you can just send us an email, send it to webinar@taxsmarttaxzero.com. Once again, webinar@taxsmarttaxzero.com. I guarantee you, when you watch the webinar, you will understand this has nothing to do with not loving your spouse. This has everything to do with money and marriage versus wealth and wisdom. In case you have just joined us, you, of course, are listening to another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. I am your host, Karen Scott Mims, affectionately known as your Tax ESQ. We are talking about the whole idea of money and marriage versus wealth and wisdom. We're also talking about the path to the 0% tax bracket. And if you listen carefully, we're talking today about unnecessary taxation. So let me summarize for you. Unnecessary taxation can take many forms. For Sam and Susie and average Joe and Jane, right, middle-class millionaires and next-door neighbors, whose assets are the result of hard work, by the way, and not inheritance, it initially referred to taking their $1.2 million of tax-deferred funds and turning them into tax-free funds, right? When they retired and Sam wanted to engage in post-retirement activities as a small business owner, we saw again that unnecessary taxation, that can be because he failed to have tax expertise in his business or hire the appropriate person. And B, Susie failed to understand the consequences of very basic tax law, what your signature means on the 1040. I can say to you that tax planning solved both, right? And again, we not only used that married filing separately status. Sam, for some reason, was thinking that we couldn't use that because they lived in the same household together. No, Sam, this is not personal, okay? This is about tax strategy, and this is about, right, avoiding unnecessary taxation. Once again, I'll say to you that there's a second loophole that we utilized with that married filing separately status. And if you want to watch the webinar, once again, you can send the email to webinar@taxsmarttaxzero. But I will say to you, one of the things I encourage you to get is a tax-free wealth analysis. It's a report that provides a very detailed analysis of your assets, right, their current structure and your current taxation exposure on a scale of 1 to 10. What does it do? It provides a written blueprint of the necessary steps to restructure your assets to generate what? Tax-free income, right, for life in retirement, a tax-efficient withdrawal strategy, and most of all, to have you in the 0% tax bracket. What does it mean? It means that regardless of the economic or political uncertainty, you have removed your assets from future taxation and, right, the possibility of increased taxation. What does it mean? It means whether there's another iteration of the CARES Act or some other piece of legislation, right, by a Congress that enacts legislation on an empty bank account on behalf of the wealthy 1%ers, it means that as a middle-class American, you will not be forced to pay that. It means that you can be elevated to swan status, sleep well at night, and most of all, it means that you have both financial freedom and tax freedom. Goodness gracious, where does the time go? You've listened to another episode of Tax Smart Tax Zero, the path to the 0% tax bracket. I'm your host, Karen Scott Mims. I thank you so much for joining us today. Barbara, if you've joined us, get back to work.
This concludes another episode of the Tax Smart Tax Zero podcast. Get ready to create tax-free wealth and start on the path to the 0% tax bracket. To receive your Tax Smart Tax Zero toolkit, you can reach us by telephone at 866-621-6660 or text the word TAX to 301-900-5758. Or send an email to tax@taxsmarttaxzero.com. Want to attend our virtual seminar, Guide to Tax Minimization, Estate Planning, and Passive Real Estate Income? Text the word seminar to 301-900-5758. Send an email to seminar@taxsmarttaxzero.com and we'll register you and also keep you updated of all future virtual seminar dates and times. Don't forget to visit taxsmarttaxzero.com and on our YouTube channel. There, you can like us and subscribe to learn more about our tax study group, Zero is My Hero, or attend our upcoming webinars. Follow us on Facebook. And as always, sign up for our monthly tax newsletter and divorce Uncle Sam as the primary beneficiary of your wealth. Join us next week for another episode of Tax Smart Tax Zero, the path to the 0% tax bracket.